Most traders think they're losing because they're bad at trading. Wrong. They're losing because there's a $12 billion machine quietly feeding on them every single year, and almost nobody talks about it. Picture this. You open your trading app, green candles, red candles. Your heart rate syncs with the chart. You click buy, then sell, then buy again. It feels like a game of skill. It feels personal. But behind the screen, something else is happening. Something mechanical, something expensive, and it doesn't care how smart you are. Right now, retail trading is bigger than ever. More people trading stocks, crypto, options, futures than at any point in history. Zero commission apps, instant execution, charts that look like NASA dashboards. It feels democratic. It feels fair. That's why this matters now, because the system looks cheaper than ever, but it's quietly more expensive than most traders realize. Let's slow this down. Every time you trade, you think the cost is obvious. Maybe a commission, maybe a small fee. But the real cost isn't written in bold. It's buried in milliseconds. It's the spread, the slippage, the tiny price difference you don't notice. You buy at 100.02. You sell at 99.98. 4 cents. Who cares, right? Except you don't do this once. You do it hundreds of times, thousands. Now multiply that by millions of traders. That's where the 12 billion comes from. Not from one big scam, from friction. Think of it like this. Imagine a casino where the house doesn't charge an entrance fee, no ticket, no cover. Instead, the floor is slightly tilted. You don't feel it. You can still win individual games, but over time, gravity does its work. Markets work the same way. Market makers sit between buyers and sellers. Their job is to provide liquidity. That sounds helpful, and it is, but they don't do it for free. They profit from the gap between buy and sell prices. Tiny gaps, almost invisible. Retail traders cross those gaps constantly. High-frequency firms don't. They skim them. Here's the uncomfortable part. Most traders don't lose because they're wrong about direction. They lose because they trade too much. The math is brutal. If your strategy makes 1% per trade, but costs you 0.5% to enter and exit, you need to be right almost all the time just to break even. And almost nobody is. This is where the hype comes in. Social media shows screenshots of big wins, perfect entries, clean exits. What you don't see are the dozens of small losses, the friction losses, the invisible costs. Nobody posts those. There's a quiet irony here. The easier trading became, the worse results got. Before apps, trading was slow. You had to think. You had to wait. Now it's frictionless, which means you trade more, which means you pay more, not in dollars you see, but in performance you never had. Zoom out. $12 billion a year doesn't disappear. It moves from retail accounts to firms built to exploit speed, scale, and impatience. This isn't evil. It's design. Markets reward whoever understands the rules best, and most traders are taught strategies, not structure. They learn indicators, patterns, setups. They don't learn where the money leaks out, so they keep patching the wrong holes. Bigger implication, this gap is growing. As execution gets faster, spreads get thinner, but volume explodes. More trades, more friction. Same outcome. A few players get very rich, most slowly bleed. And the scariest part, you can be right about the market and still lose. So here's the question worth sitting with. If trading losses aren't mostly about bad predictions, but about hidden costs and overactivity, what happens when even more people are pulled into this system, believing it's skill alone? And who exactly is that $12 billion really training you to become? Because the market is always teaching something. The only question is whether you're the student or the tuition.